Welcome to Startup Success, the podcast for startup founders and investors. Here you'll find stories of success from others in the trenches as they work to scale some of the fastest growing startups in the world. Stories that will help you in your own journey. Startup Success starts now.
Thanks, Marshall, for being here today. I'm looking forward to get into the details of venture debt. But before we do that, I think it would be helpful if we could get a quick overview of your background and then what inspired you to write this book.
Sure. Hey, Kate. Good to be on the Brooklyn Startup Success podcast. It's a bit surreal, ironically, because I have been a 20-year venture bank and venture lender until I started to write this book and left that industry. But I go back far enough. I used to have hair and it wasn't gray. For those of you looking at the video of this, I'm a very bald, grayed out, bearded guy. And I worked with Jeff Berklin, the namesake of Berklin Associates, when it was just him. And there was no business, more than 15 years ago. So sorry for making Jeff now old with me, but it's exciting to be on the podcast for this great firm that you guys have built.
Thank you. Thank you.
Yeah, I've had a long time in venture banking and lending across 4 different firms. Most recently, and for the majority of that time, I was at Silicon Valley Bank, or SVB, the sort of dominant player in the banking and lending to startup industry. We had our fun moment in the sun in March of 2023, but I stayed on for a couple of years after that before leaving to write this book. And really the impetus for this was another book called Venture Deals by Brad Feld and Jason Mendelson that probably a lot of your audience might already know, and maybe they have a copy or two on their bookshelf like I do. It's been out for about 14 years now, and it really pulled back the cover on venture capital fundraising and what that looks like, what you're going to see in a term sheet, how do investors think, how are they structured. A lot of that stuff 15 years ago was very opaque, and you couldn't, as an entrepreneur, CFO, founder, you didn't have a lot of insight into sort of how the venture capital world works. Now there's a lot more transparency in that process, largely because of that book, as well as a lot of other people have written about the industry since then. Anyway, that book came out. I thought there should be a book like that on venture debt. Took me a solid 14 years to get the courage to leave my day job and write that book with the help of some other folks along the way. But that is really the inspiration for putting pen to paper. And I was fortunate enough to have Brad Feld help in some of the early drafts, provide some commentary to what I was writing up until the point where I was locking the manuscript. And then he's the top blurb on the back. So I feel very fortunate to be alongside or getting the help from some very smart people who are smarter than me, that is, on the topic. But that was sort of the inspiration why I wanted to get the book out to the broad masses. And it's really geared towards founders, entrepreneurs, first-time finance people who just maybe haven't touched the venture lending ecosystem yet.
And I would say to everyone listening that what makes the book I found really enjoyable was all of the use case studies that you included throughout your career. I mean, it brought back a lot of memories of, Yahoo days and everything. So that's, I think, why this is such a helpful book. You can kind of hear first. I listened to it, so I heard firsthand, how these different companies used venture debt, which I don't think people realize there's a lot of use cases. So let's start at the top. What is venture debt?
Yeah, it's a good place to start, Kate.
Yes.
Venture debt is a type of financing that comes from banks or private credit funds. We'll talk about those two parties, I'm sure, in a little bit. Usually it's a chunk of money, some percentage of perhaps the equity round you might have just raised as a company. And it is money that sort of acts like a car loan, really. It goes out 3, 4, 5, maybe 6 years. You borrow it typically mostly up front or sort of all at once, and then it usually either pays down in a straight line over time, or it might, in certain cases, go out and be sort of paid back all at the end of the life of the loan. And the idea with venture debt is generally that you are trying to get an extra 3, 6, 9 months of runway on top of the runway provided by the equity dollars you've raised, Or perhaps you're later stage and you're getting close to break even and you're trying to avoid having to go raise another equity round when you're that close to perhaps getting to cash flow positive or EBITDA positive operations. So it's really a tool that can be used both wisely and poorly, depending on the context. But in the best cases, it's a tool that is going to bridge a little bit of the gap to your next round and help minimize the dilution that you as a company and founding team and your employees have to take when you go out and raise your next venture capital equity round or perhaps get to break even.
That's helpful. And I always, saw it used like when you're trying to, you've getting to revenue or you're, getting close to your next round. Where I was confused is when startup founders use it earlier. And we have a lot of early stage founders listening who have just raised that round. Why would you use this in addition to an early stage round?
Yeah. Well, early on in a company's life cycle, the bulk of venture debt deals are to early stage companies, ironically enough, the volume, the
really?
number of deals. And that's the venture banks that are playing at that early stage typically because the deal sizes are smaller. And what banks are mostly doing at that stage when they're lending companies money is it's kind of quasi customer acquisition financing. They are lending money because one of the requirements typically is that you would have to move all your banking to whatever lender bank is providing this capital. So it's sort of a way to bring in a company, provide them some useful capital, but get the full banking relationship. And ideally, you hope that can run for, the life of the company, which could be, years beyond the debt or, maybe even a decade or two, depending on the company we're talking about and how successful they are. So that's what sort of banks are doing at the early stage. And that's where the bulk of the volume of the deals in venture lending happen. The total dollars deployed in terms of quantum or size of the money is actually usually later stage companies where some company might be borrowing $100 million, $150 million. And while the volume of deals is lower, the dollars deployed is higher. So, and that's where private credit tends to play. Why? So going back to sort of why would you want to do this at the early stages of a company? These days, when you raise a Series A, I think equity dollars raised have continued to sort of inflate a little bit. That Series A's, when I started my career, I don't know about UK, but a Series A round was like $3 or $4 million back in early 2000s. Now a Series A could be 30 million maybe on the low end and 100 million on the high end. So the nomenclature is a little wonky. And behind that is both, the size and scale of the venture industry, but also most companies, when they raise a Series A these days, their product is in market. They have revenue. There's, significant business progress. It's not that they have raised on the back of a napkin or a PowerPoint presentation. That happens occasionally still, but I think these days, more often or more commonly, you're in the seven figures of revenue sometimes or at least on a run rate basis for Series A financing. So bringing in a little bit of venture debt, the nice part when banks provide venture debt is that they a lot of times will allow a company to wait to actually use it or draw it down, meaning you could have a commitment from a bank to lend you money, but you don't have to make the decision to draw it immediately. So it's a nice tool to provide you optionality 6, 12, 18 months down the road as you have made progress on your plan, whatever has happened in the business. You could say, wow, things are really working, and an extra 3 or 6 months of runway right now would be wildly impactful because we could raise venture capital a quarter or two later, and the valuation that we could justifiably get from the market could be meaningfully higher. That's the place where I think it gets used at the early stages. And a lot of people like to have the commitment there so that they can then decide whether to draw it or not. And the nice part is that if something is not working, or perhaps you're not really confident in the business, you don't have to draw the money. And sometimes lenders may not want the money drawn, but you've at least got that option already before you get to a place where you're low on your own dollars that you've raised from the Series A round that we're talking about.
Got it. And obviously every founder wants to preserve as much equity as possible. So, I mean, that's the big draw here. And then later stage, obviously, it's probably just you want to do something, you want to get to that next round, you want to get to that M&A.
Yeah, the later stage market is where most of the private credit players in this industry are. Private credit, for those who don't know, listen to the show.
Say, maybe that would be helpful.
Yeah. The two players, again, venture banks, there's a subset of the commercial banking market like SVB and HSBC and Stifel that focus on the innovation economy as part of one of their industries they want to target, and they provide venture debt. They're usually going to be the ones going earlier with lower dollar lending, call it, sub 30 million on the high end, but probably more sub $20 million to any one company. On the other end of the market, if you will, like there's a barbell, early stage and later stage, there are private credit firms, and there's a variety of type of private credit firms out there. Some of them are publicly traded, ironic given the name. Some of them are fully private, but they've all typically raised third-party capital like a venture fund from limited partners or investors that they are going to deploy and lend to other companies. They're not banks. They don't take deposits. They don't care about whether you keep your money at one bank or seven banks. In fact, that's one of their selling points, frankly. It gives you flexibility as a company. And where they tend to play is when a company needs, call it 30 million or more on the low end, but actually these days, 50, $100 million. So these are companies that are much more scaled. They're doing, tens, if not hundreds of millions of dollars of revenue, or at least on a run rate basis. And they have, real businesses that are likely headed towards some decent to better than decent, good, great outcome. And you can use these bigger dollar venture debt transactions as a way to, again, bridge to profitability, maybe buy a company. In today's market at the first part of 2026, there's a lot of companies, AI in general, but if you're a company who is a LLM, you've got a ton of capital needs to train models. If you're a chip company, you've got a bunch of hard asset financing. Even if you're a vertical application in AI, you might have, hard asset CapEx financing. Frontier tech, defense tech, aerospace, those places have big CapEx needs. So you might want to use venture debt or the debt markets to finance, that kind of spend in your business to avoid, again, having to raise that amount or more of equity and, have to sell off 5, 10%, 20% of your business to outside investors if you can avoid it.
Of course. I mean, that makes a lot of sense. And then, you mentioned in one of the differences, with the private credit market, they're not looking to acquire you as a customer for your other banking needs. So is that something that founders should be aware of? It's totally standard that if you're in an early round and you're going through a venture, debt lender, like a bank, like an SVB, that it will be a requirement?
Yeah, that any bank lending you money, whether it's SVB, HSBC, Stifel, others, like they're going to say you need to keep at least the majority, if not more, of your capital and your day-to-day banking at that one institution. However, one of the big changes post SVB's failure in March of 23, and I should say they've been acquired by First Citizens, who I worked for 2 years and are very much back in market. We'll talk about maybe the landscape here at some point, but they are back and not gone. In fact, they're still arguably one of the, if not the dominant player. But one of the big changes that was caused by that weekend of turmoil that we all, if you were in the industry, got to experience is that every bank who provides venture debt is comfortable allowing companies, as sort of a corporate best practice, to have multiple banking relationships. So that could be, your primary bank who's providing you debt and maybe a secondary bank. You might have a couple of other banks, maybe 3 or 4. The bulk of the money you've raised and all your sort of day-to-day transactional stuff will be required to go to the bank that's providing you debt, but you could have, a JP Morgan account open or a, you name it, other bank account just sitting there and holding a small amount of money so that you don't have to face. The big problem back in 23 was that just to get a new account opened in, a day and move money was really challenging. So having accounts open, ready, even if sort of not dormant, but just not being actively used, like that's generally allowed across all of the bank lenders. And again, private credit doesn't care. They allow you to have the money everywhere. However, they will take a security interest in those, dollars you have at all those banks, but they don't control where and how you have to do your banking.
Got it. Thank you for clarifying that. And so what is involved in the fundraising process? One of the things I feel like I heard in your book when I was listening to it is you don't want to cast a wide net when you've decided you're going to pursue some venture funding. Because, we get so many VCs on here and they're like, target all these people, but you were saying that isn't the way to go if I heard that correctly? Or...
From the seat I come out of, having probably directly lent money to several hundred companies, including some of the case studies you talked about at the top end of the show, Airbnb, Twitch, Clearco or Clearbank up in Canada is one of the case studies as well, amongst many others. What I think most lenders, good lenders, the firms that you would ideally want to partner with, they can sort of sense if they have become, I don't know, one of a dozen lenders in a grid where you're just, as a company, shopping for the best terms and pricing, and that's all that matters. And they still might want to compete and win your business. But what I find has led to better outcomes in the mid and long term for the company, that is, and even the lender for that matter, is when you as a company, unless you're in a situation where it's going to be maybe the debt you're asking for because of your particular situation might be challenging to get, that might be a situation where you should go talk to a lot of parties because you're going to get a lot of no's from people.
Got it.
But if you've raised a recent equity round or the business is jamming, even if you're low on liquidity, but the business is jamming and headed really in the right direction, 3 to 5 debt providers, whether that's banks or private credit funds, seems to me like 5 is on the upper end of usefulness, because you get beyond that and everyone can tell they're one of many. You, to a company, the benefit, what you're trying to get out of this relationship, in addition to just the right debt, I hope, is the right partner, which means you got to build a good working relationship with the humans involved. And that starts in the sort of diligence and sort of bake-off, if you will. You can still get a competitive process going. You can still talk to more than 1 or 2 firms, but anytime a lender senses that they are going to be one of 10 banks or private credit funds in a grid, the effort they're going to put into trying to win that deal in most cases is going to go down, and they might not want to spend the time and effort because they know the likelihood they win is very low. Versus if you said, hey, I really want to spend time with you, Kate, and your firm and get to know you. You're one of a few, here's what we care about. And you can sort of get to, I think, a better outcome. And, oh, by the way, save yourself a ton of time, because managing 10 to 12 lenders in a process, is kind of a gong show, versus if you have, 3 or 4 firms you're talking to, you can prioritize, how you want to spend time there, but also you just don't have to do a bunch of managing of talking to all the different parties. You can sort of focus your efforts. And I think that just is going to lead to a better outcome. And I know that there are, debt brokers and other people out there that work in the industry. They might not agree with the statement I've just thrown out there, but I would just say that from my experience, the best relationships, which led to me providing and my firms providing the most help to companies, came out of smaller processes that led to good relationships that got better over time, because we continued to work with these founders and CFOs and boards. So, you don't need to take the shotgun approach when running a venture debt process. And by the way, that also might be a little different than venture capital fundraising, depending on where you are and the dynamics of the company. You might need to talk to more firms, because more are going to fall out of the process. I think the hit rate in venture debt is going to be higher. So you don't need to go out and carpet bomb, for lack of a better term, the lending industry to get to the best terms.
That's why I wanted to bring it up, because it's different. So then as a lender, what are you looking for when you're evaluating a startup, and what should a founder expect, in the diligence process?
Well, time frame for a venture debt fundraise at the top would be, average fundraise is going to be 3 to 5 months. That's a normal sort of time frame. You could definitely be shorter if you really needed to, and everyone was motivated to work for a reason, M&A or something. If something's happening, you got to move faster. Have I seen plenty of processes go way longer than 5 months? Absolutely. That's usually not a good leading indicator of how a relationship's going to go. So it's that 3 to 5 month time frame, and that's really cut into three parts. One is the upfront diligence. The next would be is if you've gotten a term sheet from a lender or term sheets or that negotiation of the terms. And then once you've picked your party you'd like to work with as a company, sort of 6 to 8 weeks of legal process with outside counsel involved, and you're sort of officially papering, legally documenting this capital and your ability to use it. The front end process, the front and back end process, negotiation of the term sheet certainly could be time intensive too, but really the front end diligence is time intensive, and the legal process can be time intensive depending on what's going on, sucking up people's calendars. The good news is diligence from venture debt funds tends to be, I wouldn't call it an order of magnitude lower, but significantly lower depth and breadth compared to a venture capital fundraise. Because venture capital is you're buying a stake in the company. It's kind of the equivalent, as everyone talks about over the years, of getting married to this partner who may join your board, and that you have to be able to deal with them as a human. A lender is probably more of like a long-term relationship, but not getting married. You can change your lender over time, so it's not the same kind of depth. And then lenders get the benefit of usually coming on the heels of some kind of equity financing. So that means they can leverage some of the diligence process done by the venture capitalists and all the work that you might have as a company already done for those firms. The lenders can maybe get a lot of that same diligence info. The lenders usually want to talk to the general partners who've invested in the company, so you can get their thesis and sort of check and balance that. The other thing that you get the benefit of as a lender, again, you can make your own judgments about the quality of venture capital firm diligence these days, or lack thereof, depending on the situation.
Right.
But lenders also get the benefit of, if a venture firm they know and have worked with over the years, or a number of firms are already investors in a company and a couple, board members are there that they know, those venture firms have done the credibility check.
Yes.
Are the people involved not necessarily going to be successful? That's a different question. It's is Marshall capable of pursuing the thing that he and his company are trying to build? Venture lenders are not usually deep technologists. We understand lots of things at a generalist level, and some things specialty tech we might know pretty well, but I don't know that I could check whether someone has the programming chops, the AI research chops, the electrical engineering background that I could, really understand if they have the credibility. So that's something lenders are looking at. And then frankly, one of the things that we should talk about is like, what are lenders really underwriting? And most lenders are making a bet later stage. Sometimes it's more, is a company going to be the dominant player and the winner in the market? But that's a smaller subset of situations. Most venture lenders are making a educated guess as to whether this company that they want to lend money to is going to be able to successfully raise additional venture capital in the future. So if something's off plan, or if a company doesn't quite get to break even, or if they don't hit all their milestones, like, what do we think the odds are this company will still be able to access the equity markets, because those equity dollars will be largely used to continue to service the debt that might have been provided. And that's a different question than, is this the next OpenAI or SpaceX?
That's an easier question, like an easier hurdle.
It's definitely easier for sure.
Yeah.
Still doesn't mean lenders get that question right all the time, but they're doing more art than science to sort of figure out and triangulate in current market with the progress to date, with who's involved. How much capital are we providing at what terms? Like, sort of, what do we think the likelihood that, again, somebody's going to be able to get to raise capital in the private markets again? And that's really what they're spending time on. Again, later stage companies taking money from private credit, which is a smaller chunk of the transaction. That's a little bit more of like, we're trying to pick a winner dynamic, but most times it's just, are we as lenders, I still say we, even though I'm not a lender anymore, trying to see if this company is going to be able to, or take our best guess as to whether they're going to raise equity again.
That's really helpful that you pointed that out. And then because of that, and because there's usually a venture capital partner involved, does the lender like help the founder at all? Are they a resource at all, or is it just transactional? Here's your money, and then you all sit on the sidelines and wait and see.
Sure. I mean, table stakes in my mind is that hopefully you've picked the right partner and they've provided capital that is impactful on the right, terms and structure and economics. So let's assume that that's already been done. And maybe some companies and general partners might say that's good enough. That's better than a lot of times that we've seen this play out. But I think that undersells and really underserves the company of what could be, a more impactful relationship over time. What I write about in the book and from my own experience over, 2+ decades is that the best sort of situations were where a company thought of their lender, in these cases where it was my direct experience, thinking of me and my firm as really a strategic partner, a peer to sort of who's on the board even, and that they gave us all the same kind of transparency of both the, good and bad of how the business was doing. And ironically enough, that is something that actually will make lenders more comfortable with the business, given that we all know founders and startups are, an exercise in putting out fires and people are running around with their, from one thing to the next. Like if we don't hear what's working and what is not working directly, we have to then guess at what is not working. And sort of that's harder for, lenders to do. So when you got the open, transparent communication that was proactive, even if bad news, that actually made me and my firms that I worked for as a lender, more likely to be more accommodative and more helpful in a process. So that could be as simple as you need a little more time with the debt to repay it or something changing in the debt itself. But also there's some things beyond the debt that you could get from lenders if you put the time and effort in around, they talk to lots of businesses, small, large, medium size. They see other people navigate similar problems. If you can sort of share with them the things that you are trying to solve or top 1, 2 priorities in the company, they may not always be able to solve those problems or help, but they might surprise you sometimes with who they know, who they can connect you to, who they run into because it was top of mind and you told them what your problem was. They can sort of connect some dots for you. And I think more often than not, founders maybe don't take advantage of at least the more senior members of the firm they might be taking debt from. They're equally networked in this industry as, general partners at mutual funds. So it's to your, I think, generally no downside and all generally upside if you, treat those people like strategic partners who have the potential to help you in ways you may or may not be able to anticipate, but just keeping them apprised and informed. And I've got a bunch of good examples of stuff in the book about all this. There's just a lot of potential upside with, I think, minimal downside for founders to make sure that they are proactively communicating with their lending partner.
That's why I wanted to call it out. I did not know that until I read your book, that it can be a partnership type relationship like that, where, you're on the phone and helping out. I really thought of it as just your, what we all think of a bank loan, right? Like, here's the money. And then, so I thought that was really interesting. And when I talked to founders, as I was listening to your book, many didn't know that as well. So I think that was very helpful that you walked us through that. We're getting to time, and I'm going to talk about your book at the end, but before we get there, could you give us kind of a picture of the landscape right now? Because the SVB crisis changed things. It still seems, and maybe I'm wrong, like, is it in flux a little or no? Has it all been played out or...
All of the things from the chaos of March of 2023, I think, have largely played out.
Okay.
Are there potentially people coming in and out of the market?
That's what I mean.
Maybe.
Yes.
But let's talk about from March of 23 when SVB, and I got to experience it on 2 sides of the international border because I was helping support SVB Canada at the time. So it was a very fun moment for all of both the people who worked at SVB, sort of traumatic to this day, to be honest, as well as for everybody in the innovation economy, which was not fun up until the point where everyone knew the money wasn't going to just go to zero, or their deposit dollars wasn't going to go to zero. Funny enough, so SVB failed, and in the U.S. was purchased by First Citizens Bank. And First Citizens has been about as good an owner of SVB as you could hope. And they sort of from day one said, we know the bank didn't fail because the business model was bad or that venture lending was really risky. It was sort of a top of the house messing up your bond buying, which was unrelated to what SVB did as a core business. So they've gotten SVB back in business and jamming. So that's great for founders, that is, that you didn't lose the biggest player in the space. But there was some attrition out of SVB, both internationally, because those were all sold off differently. And then, a subset of people in the U.S. moved to different firms. But that, from a founder and company perspective, means there's actually a bunch of either newly reinforced venture lending groups at existing banks that were already in the industry, and even some newly minted ones. So HSBC, Stifel in particular, sort of new players in the space. So there's more options for companies from venture banks on one hand, and that was mainly SVB that caused all that. On the other hand, or the other bucket, private credit is sort of the asset class du jour these days. Venture lending is a small subset of private credit. But there are more private credit firms coming into the innovation space than my entire, 25 years in this industry. And that's a little bit because of the vacuum of SVB happening. But actually more of the motivation is from both interest rates being higher so that there's more economic return a private credit fund can potentially get, but also the size of what startups, given how big private companies have gotten, SpaceX and OpenAI are bigger than most public companies in terms of valuation and scale. And there's a bunch of, companies that are on that long tail from there. So there are companies that have credibly been able to ask for and get 50, 100, 200, $1 billion of capital from lenders. And that was not true up until about 3 or 4 years ago. So there were a lot of private credit firms that are some of the biggest in the world that have come into the innovation economy, the likes of Apollo, Excel, Owl Rock, you name it. So that the number of private credit firms is also at a high point. And you see this, I think, just generally in the data, both the number of lenders is a high point, but actually 2024 and 2025, both were the highest number of dollars deployed from venture lenders into the innovation economy, as far as we have data going back, basically. It's, and by a decent step up. So there's just a lot of capital and a lot of providers in the industry. That's good for founders. Probably the only thing to watch there is the longevity of all the participants. It can be great when there's lots of people clamoring for business, but if somebody you work with decides to get out of the business, which has happened in the past, when a market starts to turn over, which could happen at some point in our industry or in the innovation economy, that's where you have to just be careful with perhaps somebody who might be new to the space, making sure you've gotten comfortable that they're going to stick it out and be a good long-term partner.
Right. That makes a lot of sense. Okay, so we didn't get to cover everything. So everyone listening, the book is Venture Debt Deals. I will say I enjoyed listening to it. The use case stories are fabulous, super interesting, but you also go into like what to do when negotiating, what to look for, terms. So I highly recommend picking it up as a resource if you're going to pursue this level, this area of financing. Is there anything like you want to call out that we didn't cover that's in the book that you think that I didn't mention that would be helpful?
Well, it's very kind of you just to say it was a good listen, if only because I was the one self-narrating it. So I'm glad you enjoyed my radio voice and face in there. In general, I hope I've done a good job that, you balance some of the dryness of just the specific finance topics and what's in a term sheet with some more practical application of real world companies using real situations and seeing how that's played out. And if I've done my job well enough, I hope it's both useful, entertaining for founders and CFOs and others, and also actually useful for lenders and investors, and sort of makes everybody just more educated and better counterparties so they can work faster and get to better outcomes more quickly. So that's what I'd leave you with. If people are if I'm fortunate enough to have people listening, go pick up a copy of the book.
I think they should. Venture Debt Deals. Again, for those of you pressed with time, it's a great listen. Very easy to download on Audible or whatever your players. Thank you so much for being here, Marshall. We have not covered venture debt on the show, so I'm really excited to have you here and walk our audience through it.
Thanks for having me, Kate. I'm glad to be the best and only person to cover
Yes.
venture debt to date.
There you go. I love it. Thanks again.
Thanks.